start there with the stock of the day, which is Reliance Worldwide. Now it's going to, this doesn't sound very exciting I have to say, close its brass casting, forging and machining operations at 2 Melbourne sites as part of a rationalisation of its global manufacturing footprint. The move following a decline in brass production volumes in Australia, driven by increased automation and production shifts to its US facility in Alabama and more use of suppliers in Asia. Reliance expecting about 85 employees to be affected, expecting a one-off charge of $100 million US. Andrew, I don't really know what brass casting is, but is its earnings growth likely to remain volume dependent here? What do you think the outlook is?
Yeah, great question. I mean, look, Reliance Worldwide, of course, is a plumbing's material provider. So all those brass fittings, I'm sure, are the things we break every time we try and reconnect our hose, which is wonderful business for them. Look, I mean, it's a good business, Reliance Worldwide. Over the last 10 years, it's managed to grow sales from about just under 100 million up to just over $2 billion, and earnings from break even to around 200 million a year. Having said that, $100 million one-off charge, you could look at it one of two ways. You can either say, how did they let things get so bad? Or you can say, wonderful to management for having realised the problem and addressing it. But as a result, overall, I'd put this in the too hard basket. From our point of view as Teaminvest members, Reliance Worldwide looks like a good company, but not good enough to be in our sort of top 20 or 30 that we want to hold. High single digit return on equity, return on capital, high single digit, low double digit growth, reasonable debt, PE of 17.5, but just too much noise, both because of what they do being cyclical, building products are cyclical, and also, when you're running big manufacturing plants all around the world, doesn't have to have a lot to get it wrong for the charges to be big. So it's a hold from me. A
hold, okay. Mathan, are you going to come back with a big strong buy, or what's your view?
That just wouldn't be me. Look, Reliance Worldwide is, it was a great business. They made some big acquisition. It's just the wrong part of the cycle for the sector and the stock. And it's showing that in the last couple of years, you've gone downhill. And it's running into inflation, cost pressures, as Andrew said. They're trying to rationalize. The model needs to be restructured. And it's just, construction slowdown is happening because of costs. And you can see it in the numbers out of China. There's just not happening around the world. So there's probably going to be a slowdown, and that's probably going to affect them. Sure, I don't see the catalyst in the short term for it to rebound. And this is kind of the part of the cycle where they'll be rationalizing, and that's exactly what they're doing. I think that's not going to drive the sector at the moment. I think the market's going to wait for the cycle to turn on construction. And so in the short term, I don't think you need to be there, but if you're already there, you've taken the pain. So it's probably a hold. But yeah, I don't see the catalyst that you need to chase this stock today.
All right, so a hold from both our guests there for Reliance Worldwide, their $100 million one-off cost, of course, what Andrew was talking about, and also reasonable debt there, and Mathan saying that he doesn't see a catalyst for a rebound, but if you are there, just hold it, but doesn't see particularly a need to be there.